Joining me now is Santosh Rao. He is head of research at Manhattan Venture Partners. His firm was an early investor in Lyft. Okay, so you just heard Logan Green, profitability number 2 on his list. Should it be number 1?
Well, good morning.
Good
Thanks
morning.
for having me. Thanks for having me again. I think they're on the right track. They're not in a rush. They don't want to pull in the timeline. And that's one of the reasons why we invested right from the beginning. We feel it's a pure play with a focused strategy, very disciplined strategy. So I think that's what they're doing. They're executing to that strategy. They're not in a rush. Like he said, profitable growth until the last quarter of 2021. They will be profitable. So I trust the numbers. I trust the CEO. So I think he's on the right track. And this quarter was a classic beat and raise. Fourth quarter right off the gate, doing great with big numbers. So I think this company is on the right track, and our thesis is proving out that this is the way to go.
So you were an early investor. Are you currently an investor in Lyft?
No, we are not. I mean, we distribute the shares after the expiration, but we were early investors, like I said.
Okay. And so you mentioned that Lyft is a pure play, and you mean because they don't have a Lyft Eats like an Uber Eats. But some people point to that as actually a really good thing for Uber. You don't think Lyft needs that?
No, they don't need that. I mean, Uber Eats, Eats business is good, but it's competitive. That's the thing about Uber. I mean, Uber, it's a different game. It's a platform. It has a number of other businesses, not all profitable. We don't know when they'll be profitable, but it's a broad platform. But I think the way to go is the ride-sharing business in North America, which has the best unit economics. So this is right focused very well with the optionality later on of going into other businesses. I would rather go that way than go this way because there's a lot more to do here. The market is big. There's a huge opportunity out there. It's still a lot more to go, still early stages. So I think they need the resources and the attention to execute here and then later on try to go into other businesses if needed. But they don't need to.
So a really important part of North America is California because it's a huge state. And we've got this gig worker law on the books that these ride-sharing companies and a number of others are just not thrilled with, frankly. I mean, how big of a threat is this? And will this continue to be an overhang for investors?
Yeah, I think it's still playing out. Lyft is banking on a ballot initiative. They're confident that they can win. But let's see where that plays out. California is not the biggest part of the market. I mean, it's big, but it's not all the business. I mean, there's a lot of other businesses around. So there'll be some hit, small percentage of the total earnings, I guess. But overall, I think we'll see. I think the genie's out of the bag. You cannot take this back. Ride sharing is the way to go for the future. Everyone wants that. There's a groundswell of support from bottom up. So you'll see at somewhere in between, you will settle. There will be a compromise somewhere. But in the end, you need gig economy. You need ride sharing. That's the way to go. Transportation as a service is a big part of the future. That's where we invested. That's why we thought this was the right place to go.